Hi, Professor Barati. I'd like to go over Chapter 16 this week. I think it's an important chapter in the auditing cycle, completing the tests in the sales and collection cycle, accounts receivable. As a controller who basically has to work with our CPA firm every year in the auditing process, I could assure you that auditors, especially in small companies, we'll do a lot of testing in the accounts receivable and the collection cycle, because the accuracy of accounts receivable will basically give auditors a comfort level to the accuracy of sales, because in accounting, as we know, when we issue sales, record sales, we debit accounts receivable, we credit sales. So if accounts receivable is fairly accurate, auditors begin to basically use judgment as to the accuracy of the sales side. In addition, when we collect our sales, we basically debit cash and credit the accounts receivable. So the accounts receivable is going to give the auditors the comfort level and the amount of testing they need to do on sales and cash, but they usually start with accounts receivable. So this chapter basically has a few objectives. It describes the methodology for designing tests of details of balances using the audit risk model. The evidence that needs to be obtained from tests for details of balances, like in the AR account on our general ledger, must satisfy 8 balance-related objectives. The detail needs to tie in. So in other words, your AR aging report, which is essentially a subsidiary ledger, that balance on that report needs to tie into the balance on the trial balance, on the balance sheet. Existence, completeness, accuracy, classification, cutoff, realizable value, which I've put into the discussions for you to make comments on, and rights. This is basically a chart that summarizes the different balances in accounts receivable, identify significant risks, and assess risk of material misstatements for accounts receivable. Set performance materiality, what auditors are willing to overlook. Assess control risk for sales in the collection cycle, so internal controls are basically analyzed. Design and perform tests of controls, substantive tests of transactions. Okay, so following basically the AR cycle through the general ledger, through the trial balance. Design and perform substantive analytical procedures for AR balance. Design tests of details of accounts receivable balances to satisfy related audit objectives. Tests are based on the auditor's risk assessment. As part of the assessment of risk of material misstatement, the auditor determines whether any of the risks are significant risks. For most audits, revenue recognition is considered a significant risk. And that is because revenue recognition, what we record as sales in our books, is basically our income statement. If our revenue is wrong, our operating profit, our net income is wrong, and so on. Set performance materiality for accounts receivable is phase 1. Assess control risk for sales and collection cycle. So know your internal controls over sales and cash receipts. Make sure that one person in a company is not recording several transactions, such as billing, cash deposits, cash collections. Someone who does that shouldn't be doing the bank reconciliation. There's there should be segregation of duties. Methodology for designing tests. Chapters 14 and 15 cover designing the audit procedures, which is what auditors do behind the scenes. People sometimes wonder why audits are so expensive, because the auditors might just spend a day or two at your office. Most of that work they do is this right here, designing the audit behind the client's time. Here's a chart that shows the different risks and the 8 criteria across, and how auditors might assess that risk. Substantive analytical procedures for AR. Design and perform substantive analytical procedures phase 3. Auditors performing both planning and substantive analytical procedures for the entire sales and collection cycle, not just AR. So on the left are your analytical procedures. Compare gross margin % with previous years. Possible misstatement could be an overstatement or understatement of sales in AR. Compare sales by month, by product line. Compare sales returns and allowances as a percentage of gross sales. So as you can see, there's almost like a lot of ratio analysis going on here, where the auditors are using historical metrics of your company and looking at possible misstatements. They will look at sales, sales returns, gross margin. They'll look at % changes year over year. And they're going to ask a lot of questions. And so they'll look at major accounts on your balance sheet and your income statement. Number of accounts receivable balances over 100,000. In 2016, there were 37. In 2015, there were 32. Which means accounts receivable balances, more accounts are over 100,000. Might require some testing. In this case, gross margin has been fairly consistent throughout the last 3 years, from 14, 15, and 16. Sales returns and allowance have been consistent. Bad debt expense has been close. And so on. The net accounts receivable to total current assets has increased over 015 and 014. So there's an area where an auditor will do more substantive testing and come up with the answers as to why receivables as a % of total current assets have increased. Part of that answer is in the slide before, which stated that 37 accounts, 5 more accounts than last year, have balances over $100,000. The appropriate test of balances depend on the factors listed in the evidence planning worksheet that we saw. Designing tests of details of balances. The aging. Age trial balance is a very important report for both internal and external users, such as the auditors. The aging lists the balances in the accounts receivable master file at the balance sheet date for each individual customer. It categorizes the balances due based on an aging grid or time passed. So here's a typical aging trial balance. Atom supply at the end of 016 had a balance of $146,589, of which 0 to 30 days were 90,220 and 31 days were 56,369, and so on. So auditors will basically test this. The total balance of $20,196,800 should be the total AR balance presented on your balance sheet. The way to test these balances and their accuracy is for auditors to send confirmation letters to those customers with the balances on them and asking them to confirm those balances. Normally, classification of AR is relatively easy by reviewing the aged trial balance for material receivables. Auditors should also verify whether any of the accounts or notes receivable are non-current and should be classified as such. So any receivables that are not expected to be collected within a year will likely be reclassed as a non-current asset. Cutoff is an important feature in auditing and could lead to misstatements. Cutoff misstatements can occur for sales, sales returns and allowances, and cash receipts. Decide on the appropriate criteria for a cutoff, usually a month end or a year end. Evaluate whether the client has established adequate procedures. Test whether the cutoff was correct. Accounts receivable is stated at realizable value. So what does that mean? It means that accounting standards require that companies state accounts realize receivable at the amount that will ultimately be collected, which is the realizable value. The realizable value is equal to the gross accounts receivable that you see on the trial balance, aging, less the allowance for uncollectible accounts. The allowance for uncollectible accounts is an estimate for bad debt and should be netted against the gross accounts receivable to come to a realizable value. In this case, the AR balance, an estimate of what is going to be collected in a certain category, is put forth. Client having rights to accounts receivable. Normally this is not a problem. The auditor must determine if any receivables are pledged, assigned, or factored. And that would indicate a different classification on the balance sheet. Accounts receivable confirmation. Basically, as stated before, the auditors will test the balances by sending letters to the customers to verify the balances. If there is a negative confirmation, a communication addressed to the debtor, but requests a response only when the debtor disagrees with the statement, is a negative confirmation. A positive confirmation is a communication addressed to the debtor requesting the recipient to confirm directly whether the balances as stated is correct or incorrect. Here's an example of an auditor's confirmation letter to a client's customer. And you can look that over. Basically, that's a good example of what a confirmation letter looks like. And the account confirmation. Negative confirmations are acceptable as the sole substantive audit procedure only when all the following circumstances are present. The auditor has assessed the risk of material misstatement to be low. Population of items is made up of a large, number of small accounts. The auditor expects a low exception rate. The auditor reasonably believes that recipients of negative confirmation requests will give the request adequate consideration. The most reliable evidence for confirmation is obtained when they are sent as close to the balance sheet date as possible. To complete an audit in a timely manner, confirmation at an interim date is permissible if internal controls are adequate. But timing is very important. In other words, you close your books timely, you get these confirmations out with the right numbers at the end of a month or a year. The longer you wait to get them out, could result in discrepancies. Sampling decisions, sample size is based on the following factors: performance, materiality, inherent risk, control risk, achieved detection risk, type of confirmations. Verification of addresses and maintaining control. The auditor should perform procedures to verify the addresses or email addresses used for confirmation. The client may assist in preparing the confirmations, but the auditor must be responsible for mailing, and the return address should be the auditor's return address, not the client's. If there are non-responses and provide no audit evidence, though non-responses to negative confirmations provide some evidence. When positive confirmations are used, auditing standards require follow-up. Evidence of the receipt of cash for payment. Duplicate sales invoices. Examining duplicate sales invoices are useful in verifying the actual issuance of an invoice. Shipping documents. These help to determine that a shipment was made, and it always helps to have signatures that the goods were received by the client. Payment has already been made. The customer has made payment prior to the confirmation date, but the client has not recorded it. These should be carefully investigated. Goods have not been received, typically because the client records the sales of the ship date, but the customer may not have received the goods. Return goods and clerical errors. When all differences have been resolved, the auditor must reevaluate internal control. Design audit procedures for the audit of accounts receivable using an evidence planning worksheet as a guide. So developing tests of details audit program, balance-related audit objectives and audit procedures are presented in tables 16.4 and 16.5. And these are in the text. And that concludes AR. So the takeaway from this really is strong internal controls, testing, basically looking at evidence of invoices and cash receipts and following those invoices and cash receipts right through the general ledger, making sure that no one person is doing all the transactions. Those are some of the key elements that you want to do when auditing, especially small business clients. Thank you for listening.